Hi, this is jeng, and today we're going to be talking about underwriting a broken deal. And I want to start with two quotes. Number one, this comes from a Fannie Mae lender this past week. The underwriting, quote, the underwriting of all transactions across the board has come under scrutiny. And this came from Trammell Crow back in the 1980s. One of their executives said, if you bottom fish and don't have staying power, you get swallowed up. So let's jump into it. So we're going to talk about a broken deal, a little bit of a case study, and then go through some historical market data for DFW specifically. So my background, born and raised in Houston, the past, since 2007, have been really involved on commercial real estate side. First as an underwriter at G Capital, and then has originated close to 750 million in multifamily debt over the last 5 years as a mortgage broker, and invested in close to 6,000 units across 21 properties in DFW, Austin, and San Antonio. So let's just start with a little bit of a market update. 2008, it really started with securitizations going bad and that impacting the liquidity for banks, and basically halted the economy once Lehman failed in 2008. This has been the opposite. This recession has been different, right? So the economy is halting because of all these closings due to healthcare, COVID-19. That's impacting tenants. Tenants can't pay borrowers. Borrowers can't pay the banks. And essentially, these securitizations are starting to go bad, especially on the CMBS side right now. So the government sort of put that in front and said, look, we're going to give money to tenants, whether that's through their business programs like PPP or just sending stimulus money to people. And, essentially all the jobs, this shows a chart that all the jobs from basically the beginning of the expansion, so February 2010 all the way to February 2020, there was about 23 million jobs created. And just in the last 4 weeks, we've lost close to 26 million jobs already. And one of the parts of the CARES Act that is interesting, Newmark put out this schedule comparing your income. Essentially, if you make under $57,000 with unemployment, the additional unemployment, you will now essentially make the same or more, right? So if you made 40, anywhere from 30 to 50,000, you essentially are making more now on unemployment. And so there should be plenty of money to pay rent. The question is, will people pay rent? So we'll have to see how May collections ends up being. But April collections, pretty much everybody, I would say A's at 95%, B's about 90%, C's are probably 80 to 85% collected going into the last week of April. So let's talk about why deals are going to break. Number one, I would say if they're struggling before COVID. So if you're doing major rehab, major reposition, and you had pushed out all the tenants and you wanted to rehab all the units, and now you're 80% or 70% occupied right now, and 40, 50% or hopefully more pay rent, but majority of those people, you're probably only at 70% collection on a 70 or 80% occupied property, and that's just not going to cash flow. Number two, bridge loans done at higher leverage with near-term maturities. So if you took maybe a 3-year loan in 2018, 2019, now you're coming up on a maturity, and you were, forecasting higher rent growth, and thus you'll be able to refi or sell the deal. That could be another reason why a deal breaks. Deals converting from IO to amortization. If you have not executed your business plan in time and haven't gotten the cash flow up, the amortization might kick in and you might not be able to pay it. Number four is actual expenses. Let's say you were super aggressive on your expenses and now taxes come in. Whether it's assessed value, maybe you underwrote 60, 70% of purchase price, and now it's coming in 100, 110% on taxes. Insurance has been up for Texas for sure. Most people underwrote 250 to 300 door. Now it's close to 400, 450, 500 door. Payroll, a lot of times we're at 1,000 to 1,100, but a lot of people's actual payroll is probably 13 or 1,400. R&M, as you hold the deal longer. So if you thought you were going to sell the deal this year or even last year, now you're having to hold the deal longer. You don't have as much in CapEx to do turns, so your R&M is going to be higher. So the combination of all those expenses getting higher could outpace, especially with flat rent growth or negative rent growth. Fifth is employer concentration. So if your deal is close to a major employer, and that major employer has, let's say, their auto plant closed, or their store has been shut down, that's going to impact your specific property for sure. Undercapitalized ownership groups. If you went into a deal undercapitalized, you couldn't do all the rehab, and now maybe you're doing the rehab out of cash flow. Now there's no cash flow. That's going to be a problem for these ownership groups. And once you can't make the mortgage payment, a lot of people are probably going to just have to sell a deal before it gets to foreclosure. Hopefully it doesn't get to foreclosure, because once you have foreclosure on your record, it's there forever, and every lender is going to ask about it in the future. So here's a case study of an $8 million Class C deal here in DFW. Essentially, let's say purchased in 2017 with, they bought it for $8 million, about 500,000 in rehab, so 8.5 all in on the deal for 150 units. Currently 80% physical, 60% economic, and it's all bills paid. And the current loan is $7 million. So it's essentially an 80% loan to cost loan back in 2017. And now let's get into how it's performed. So in 2017, when they bought the deal, essentially the NOI was 550, debt service 350, cash flow 200,000. So your cash on cash was great. It was close to 14% on a 6.5 cap rate. 2018, everything went to plan. Revenue's pretty much the same, a little bit higher. Expenses came in a little bit higher, but overall NOI was good. Net cash flow 200,000 on 1.5, so 14% as projected. 2019, you start running into some issues. Your revenue's down 200,000, expenses essentially flat, and the deal starts amortizing, and so you're actually negative 70,000 in 2019. And then on T12, the revenue has continued to decline. Expenses are 1.05, and the deal's still amortizing. So you're negative 240 on the deal. So let's take a deeper look into income. Net rental has essentially, started at 1.3, slid about 50,000, then it slid about another 100,000 here in T12. But then the other income really got hit. So essentially this property was rubbing back for everything, utilities across the board. So whether it's water, electric, trash, sewer, all of that. And then when it switched over to all bills paid, it couldn't raise the rent. So that's impacting your total income. Essentially dropped from 1.6 million all the way to 1.2 million. On the expense side, we talked about the main things really were, so taxes have come up. It's essentially over 100% of their purchase price. Insurance has increased because of everything in Texas. And then payroll, most people start at about 1,000 a door. And now this one's probably close to 1,500 a door. And so, brokers are going to take a look at some of these deals and give you a pro forma. And this is one broker's pro forma. Essentially, they're bouncing back essentially $300,000 on, or $250,000 on year one net rental, and then expenses about the same. So you're really driving NOI from 260 all the way up to 550. So it's pretty optimistic, I think, for a year one pro forma. This is how I actually underwrote the deal. I brought it back. So year one, I just kept flat. So I looked at T3, T6, T12, and just figured out what the most sort of conservative number coming into it. Most time, you could take the lowest. T12 is probably the lowest at 1.23, but I came in the middle of those three metrics, and I focused on growing really the physical economic occupancy over 3 years. So I brought it back from 1.271 all the way to 1.56 in year three on net rental, and that equaled sort of the 2018 number. I kept other income essentially flat. I think I grew it to about 2%, and kept with the all bills paid structure. Expenses. So let's say you come in and buy the deal for lower than their purchase price, then you can show that to the county, reduce your purchase price or reduce your taxes. And I use pro forma insurance, payroll, and R&M. Insurance $450 a door, payroll I brought up to $1,300 a door, and then R&M $700 a door, which is just a little bit higher, but just wanted to have a little buffer. T12 utilities, 3.5% management fee, $300 per unit replacement reserve. So if you look at this pro forma, a couple of things to notice. Really, you have no cash flow. until year 4. Year 3, there's a little bit that you eke out. Um, but then you're essentially feeding this deal for 3 years. And then year 4, year 5, I put a 7.5 cap on it on the residual. I mean, you could use something a little higher if you thought was prudent, but essentially your gain. So you say you sell the deal in year 5 for 9.7 million. Um, that's going to essentially get all your gain in the back end of this deal. And so you're going to have to put up the interest reserve and carry the deal for the first couple years and then get all your money at the end of the deal. And so the sooner you execute, this is about a 19% IRR over those 5 years. So the sooner you execute the plan, the better, the higher the IRR. But right now I'm doing a 5-year projection. So let's go to sources and uses. Like, how much money do I need to raise for this deal? Let's assume the purchase price is 7.5 million. You assume the loan of 700,000. So you really only need sort of 500,000 in closing costs at close. But I wanted to build in, sort of looking at this from an entire equity raise position. Number one, interest reserve of at least 12 months, so 423,000. That I was projecting about 300,000 for you to need on interest reserves over the first 2 years. Working capital of 200,000 and rehab of 200,000. So this is an older property, so I think there is going to be some rehab that you're going to have to go in and do, and then you need the working capital to do that. And then in order to qualify for a $7 million loan, you're gonna need 700,000 post-close liquidity, 7 million net worth, and in previous multifamily experience with Fannie Mae. So they're not just gonna hand this over to somebody who's never done a deal before. They're gonna want to see someone who potentially has experience in this market and potentially has shown that they can turn around properties before. And then before you put that 1.4 down, I'd probably do some stress tests on top of the pro forma. Number one, physical vacancy of 12%, which we'll talk about, 2 years of flat to negative rent growth, at least 100 basis points of cap rate expansion, and be able to hold the deal for at least 5 years. So I'm going to show you some charts from historical DFW. Number one, let's talk about vacancy. So this is a Class C deal. So we saw vacancies in DFW. In the last downturn, sort of 09, 10, 11, go up to 12% on Class C. Should be down at 5% right now. We're forecasted to be down about 5%. So biggest spike was in Class C. So Class B was about 8, and then A was about 6%. So that's why I showed that stress test of about 12%. In terms of rent growth, so the last downturn we showed about 6 quarters of negative rent growth. So at least that first year, that's why I didn't do anything on rent growth for the first, as you're coming out in the pro forma, just really focused on occupancy and making sure collections are there in the first couple years of the deal. And then historical cap rates. So we saw an expansion here across this shows preferred versus primary. So Dallas Fort Worth is really in that primary slot, and so it expanded in 9 and 10, and then has come back. I'm down closer to 5% on average right now. So it expanded all the way up to 7% on average. So a C deal, you could probably take all the way up to 7.5, 8.5%. I don't know if we're going to see that much expansion right now. There's a lot of dislocation just because of the number of transactions, but I think 7.5, which is about 100 basis point spread right now, would be sufficient at this time. And then this shows historical cap rates. So, I mean, this is through CoStar data. I really showed this chart not necessarily because of the actual numbers, but because of the spread between. So, the bottom is Class A, middle green one is Class B, and then C's at the top. And you can see how they've all compressed. This was only through 2017, but it compressed even more. So I see it expanding back out. I don't know if we're going to go back to 10% cap rates, but maybe 7.5, 8% on C's, and then maybe 6.5 on B's, and then 5.5 on A's over time. And here's some historical sales volume for DFW. You can see, I mean, I would say we're similar to sort of 2008 right now. We're going to have that decline this year, year over year. Next year it might be even tougher for deals to come out. So that's why I projected a 5-year hold, because essentially you could see it took about 5 years. So 2007 to 2012 is when the volume came back in terms of DFW sales last time at the last recession. So if you like this video, subscribe to the YouTube channel and like this video. If you want to talk to me specifically about any deals, buying, selling, refinancing your next multifamily deal, definitely give me a call or shoot me an email. And then you can see all my loan closings at txmultifamily.com. And you can click the link to start on my Multifamily 101 series as well. Thanks.